Welcome to the Money Mastermind Show. Let's talk money.
And welcome to the Money Mastermind Show. With the stock market acting so nutty lately, it's so easy to panic and sell. But is that the right thing to do? So we're going to go over tonight, we're going to talk about basically what the stock market's been doing in the last week or so. But maybe the bigger picture is what you should do with your own portfolios when the stock market is starting to act a little crazy. Welcome to the Money Mastermind Show. Tonight's panel is the Money Mastermind Show. We have Kyle Prevost from youngandthrifty.ca, Miranda Marquit from Planting Money Seeds, Peter Anderson from Bible Money Matters, Tom Drake from the Canadian Finance Blog, and I am Glenn Craig of Free From Broke. We've been doing this show for over a year, and I think I'm always peeking down to make sure that I get each and every one of your sites correct, because I know that if I try to do an automatic, I'm going to really fork it up somehow. But
did you just say hork it up?
Fork it up.
Oh, because my dad was saying hork it up the other day, and I just was like, are you and my dad like on the same wavelength?
That's a scary thought.
Before we start, we do have an event page set up, so if you're watching us live and you have a question about what to do when the stock market starts acting nutty, post it, because we do want to hear it, we want to discuss it, and we want to give you at least some sort of answer. It may not be the answer you should take, but we'll discuss it and see what we come up with. So, the stock market, pretty crazy this past week or so. If you missed the whole thing, maybe it didn't make too much of a difference, but if you've been paying attention to it daily, it's enough to tear your hair out, depending on who you are. So, what do you guys think? It's been pretty crazy.
So I missed the monumental 400 or 500 point drop, whatever that was, that one Friday. I missed that completely because I was, doing more important things, like I'm not even sure what, but it was not paying attention to what the stock market was doing. So I missed that Dow drop. That Dow drop, which is what most people think of as the stock market. They think of the Dow, which of course, obviously, is not the entire stock market, but that's what most people think of. Anyway, so I missed that completely, and I only found out about it when somebody was like, so your job must be pretty fun right now, and I'm like, what are you talking about? And they're like, the stock market, and I'm like, well, maybe I should go look. So I looked.
So maybe it's good, because I think we've all mentioned on this program before, a little bit on our views towards ignoring the noise and stuff. What would make a person, what are some common things you guys have saw amongst friends and acquaintances and whatnot, maybe financial blog readers or hardcore readers? What are some reasons why people would sell? What's the mindset, or what are people trying to gain when they see the stock market going down? They're like, sell. What's the rationale there?
I think the rationale is, oh my God, I got to get out before everything is gone, before every last single penny is just gone.
I think it's a big part of it is a misunderstanding of what to do, what, and the long-termness of what's happening.
Oh yeah, for sure. Well, and that's the thing is in the moment, all people are doing is they're looking at this situation where they're like, oh my gosh, it's falling. And if it falls more, what if I lose half my retirement fund? Or what if they're looking at this balance on paper, and they're not really realizing that right now it's not, those losses aren't realized right now. They're not realized until they actually sell. So it's just a paper problem until they actually lock those losses in. Ask anybody who just freaked out in 2009, right? They freaked out. They're like, oh, my 401k has lost half its balance. I got to get rid of all the stocks and sell now and get out now because it's so awful. So they sell, they get out, they lock in all their losses. And then what happened in 2010? Well, up till now, we've been running practically a 6-year bull market at this point.
Yeah.
And they locked in those losses. If they had stuck around, they would have overcome them and then some.
Yeah, I think I've mentioned on the program before the interesting reaction I get. I teach when I teach personal finance, and we talk about stocks and that in my course. And the kids go home, they talk to their parents, and the parents go, "What is he doing? Telling you to get into stocks?" Everyone lost their retirement. That's the common phrase. They lost their retirement in 2008, 2009. And I explain just what you said, Miranda, and I say, let's take a look at a hypothetical portfolio or whatever the case may be. Let's throw darts at a S&P 500 chart and say we had these stocks in 2008 and we held them till now. And of course, almost every time you've, in many cases, gained 30, 40, 50% on your basket full of random stocks or even mutual funds, whatever you're doing. And they're just amazed. And they go home and the parents say, no, people lost it all. I know that they lost it all. And it seems like that fear tends to stick with people over the long term a lot more than sort of gradual gains do.
And I think also it's everybody, I think, feels like they might know somebody or know somebody that did take a big hit on it. I know people who got hurt in retirement because of the stock market, but there's usually reasons for it. And it's not necessarily because the market is going wacky over one day or 2 days. I think there's bigger reasons that probably we should talk about as far as why.
The reason is they sold.
Well,
they sold in this position.
It could be that they sold, but I think there's more to that too. I think some people get hurt if they're not diversified enough.
That's true.
The stock market could go down because maybe one company fails. And if you're heavily into that company and it goes down, you're going to be hurt. Or if it goes down and you're retiring the next day, maybe, and you're going to be drawing money from it. If it's very recent, then maybe you're really exposed to it. But I think really diversification is a big part of it.
I was going to say, that's the big thing. You hear about all these people that lost their entire retirement. A lot of times it's these people that are nearing retirement, they're 60 years old or something, and they haven't actually sat down and thought out, maybe I want to start transferring some of this money into something a little bit more stable than stocks, put a little bit more of the money I have into bonds as opposed to stocks, so there isn't as much fluctuation in the values and so forth. And that really needs to be part of your long-term strategy, is thinking, how is my assets, how are they going to be allocated over time as I get older, and that's going to be changing over time, ideally.
Right. Oh, and it doesn't even necessarily have to be stocks, but it could be, I think, other companies or other sectors too. Am I all too much into one thing? If you love one company and you're putting everything in it, you're letting it ride on that one number, what happens when that one thing somehow goes down for some reason?
I've talked to some people too where they realize the market will go back up. They get that part, but it's almost this thought of, it's gone down, but it's going to keep going down. So I'm going to get out now and I'm going to buy lower. But this might be the bottom. It might just be a 1 week drop. so they almost think they're being extra smart by it. I'm gonna sell it now and I'm gonna buy it again later, and it may not go down for months and months. So.
Right, and that's the thing too, is I was kind of in the more recent drop. I'm like, well, should I buy a few extra things? I mean, it could go lower. I mean, really. But I mean, look at today. Today it's up almost the Dow is up almost 300 points at the end of today. The day that we're recording this and talking about this, the Dow's almost up 300 points. But I mean, it's had this massive fluctuation in the last month. It's it's down more than 1,000 points on the last month. So, what are you going to do?
Yeah, I kind of get a kick out of the whole everything's on sale. And then you look at the historical price to earnings, which I'm certainly not a stock market genius. I have like 3 metrics that I pretty much base just about everything on, and one of them is like price to earnings. And like historical price to earnings, which is, it makes sense to me. How much am I paying for the company divided by how much money did it make, right? And that's pretty much right on average for the most markets. If you look at historical versus future earnings, it can shift up or down, but it's not far from historical averages right now, using the metrics I use. So I don't see this like big rush to go buy and try to time the market like Tom was saying.
And maybe, let's talk about, I'm going to admit, I've been doing so many other things, and maybe that's a good thing too, but, I'm not sure I have my head around why the market's been acting so crazy. I know China's involved. Can
That's all you need to know.
Yeah, but can any of you speak to like why?
Well,
why
basically,
people are panicking, going, you know, we have to sell, we have to not sell, you know.
so China's growth numbers are, you know, not as good as everybody had hoped. China's not growing at 8 or 9% a year. And so people are getting a little, you know, worried because China is the second largest economy in the world. You know, they surpassed Japan a couple of years ago. And so they're the second largest economy in the world. Everybody's worried that a China slowdown will mean a global economic slowdown. And, you know, the U.S. hasn't recovered sufficiently to make everybody feel good about stuff. You add in there the fact that, you know, the Fed is still saying, hey, we still hope to raise rates by the end of the year, which of course makes companies upset because when it comes down to it, those rates influence what they borrow their money at. It influences their profit margins down the road. And so that kind of gets traders getting all crazy and thinking weird stuff. And so it's just this kind of mess of things. But right now it's mostly China scaring the crap out of people.
In Canada, it's real simple. The U.S. buys half our stuff. China buys the other half. If China's not buying our stuff because their crazy government-ran economy that no one really knows about and half the books aren't even public on, if they're not buying stuff, our market doesn't do very good. So Tom's province of Alberta, they're seeing longer unemployment lines. The end.
But you know,
Well, and then don't forget that in Alberta you've got oil issues too.
Yeah, we're officially in a recession here in Canada, just announced this week too, so that'll add on top of it for our country.
Right, yeah, because your oil prices are down, so nobody feels good about buying stuff.
but you know,
You better sell your house, Tom. You better sell it now.
Were you talking about numbers not being published and like not really understanding where the things are coming? Was that what you were saying, Kyle, from China?
Well, basically, like again, I'm the furthest thing from a Chinese academic who could explain this, but the Chinese market is part part capitalist based, I guess you might say. It's a free market for some companies, but with a strong government element, which means government owns large swaths of the market, and some of it is still supplied economy, which means the government determines how much is being sold and produced. And so what that does is there's like a lot of speculation around if these companies are reporting the real thing, or if the government is trying to like artificially juice things using different strategies. And it's pretty complicated stuff that I think most people would be quite safe ignoring.
Right.
At least I hope so, because I am.
Let's not forget that China devalued their currency a couple weeks ago relative to the dollar. Let's not forget about that either. And that kind of freaked people out too. China's sitting here trying to be like, we want to be a reserve currency. Come on, IMF, throw us a bone. And IMF's like, dude, you're still pegging your currency to the dollar. So, but yeah, they devalued their currency twice a couple weeks ago.
I'm only playing an accountant on this show. I mean, I do have an economics degree, but it's not like a deep degree. But yeah, it's like when China says they're growing at like 20%, you know, who's saying that? We're supposed to believe, like, for all the things we're supposed to believe from them, this is what we're going to believe. Like, oh, okay, that's great. Everything's good. So, like, I've always had.
I don't think they've ever said they're growing at 20%.
But they've had, like, double-digit growth. They've had very high growth compared to the rest of the.
Oh, yeah.
Certainly compared to the U.S., compared to other places. And that's why people care so much about China. They're growing at such a rate that everybody's like, look, if they're growing that fast, that's great. We could build 1,000 billion more McDonald's there and Starbucks and everything else. Like, that's kind of the hope, right? We could sell them that much more.
Everyone will buy a car. Yeah.
That's it, right? But, you know, who are we really believing? Like, I mean, if I could at least have an inkling of doubt about what their numbers are and how feasible it is, like, you know, okay, there's a lot of China, right? And there's a lot of potential for growth. But that doesn't mean that everybody that was, you know, agrarian all of a sudden is going to be doing tech stuff. You know, it's not just like the Borg going right through the country and redeveloping it all where they're just going to buy everything up. So if I have that inkling, the professionals don't have that either. You know, like, do they really know something more than I don't? I have a feeling they kind of don't. So it's like, it's not a surprise that they change their numbers and say, you know what, yeah, maybe it's slowing down a little bit. Like, you know, they massage their numbers a bit. You know, so should we be flipping out over it when they do that?
No.
We should not.
No.
There's your answer.
Even though it happens, for sure it happens, you know. I would love to be able to see some kind of synopsis of like how the market actually happens. I bet if somebody can like just pull all that data up and go like, what was that first big sale that started it? You know, somebody saw something happen.
I'm sure the market is totally efficient and works on logic and is not influenced by people at all.
Like here's the thing.
Did I convince you that I believe that?
on any given day in probably the last 200 plus years the stock market has been a thing in most areas, you could probably find a reason not to invest. Like even you look at the last 6 years, which has been this incredible bull market. We've had, the USA is down, they're never coming back, and then China, and then the Greek debt crisis, and all of a sudden there's pigs now. It was Portugal, Italy, and Greece and Spain, and then the BRIC countries, they weren't growing anymore, and there's always a fear button being pushed.
Yeah, and don't forget that the dollar's just screwing all the companies over in their earnings because the dollar's just too strong now.
Yeah. And I take a long-term look. You look at the last 100 years where the stock market's averaged, at least in the USA and in Canada, between 9 and 10%. There was like 2 world wars, several other large-scale conflicts. There was like insane labor strife, just crazy stuff. There was like nuclear war threats relative to now, and the stock market did just fine over that length of time. So it all looks pretty minor when you think about like a few government accountants in China shifting columns from one to the other. It seems pretty small potatoes to me.
Yeah. This is one of those things that it can be easy to get caught up in the flood of negative media and everything these days, but it's not anything new. This has been happening since the markets began. If you look it up and look for stock market crashes or those types of things, you'll find all sorts of them, even way back when it was first starting. The Panic of 1837, the Panic of 1857, Black Friday in 1869.
Oh, that was a bad one. I remember that.
All the way through today.
Did okay during the Civil War, but 69. Oh.
Yeah, back in those days, the markets were a little bit crazier. They could be shifted by, 1 or 2 extremely wealthy men, the Vanderbilts of the world and so forth. They could take their money in or out of the market and completely crash things if they wanted to, or save things on the other end of it. But really what it comes down to, if you look at the last 8 decades, S&P 500 has only had 2 decades where it's been negative growth or whatever. So, and it's been averaging almost 10% over the past 8 decades. So you really need to take that long-term view, especially if you have a long term to invest. Now, if you have a shorter term to invest, that might be another matter. You might want to think about a different strategy. But
yeah, well, and I think it bears some talking about too when we're talking about the stock market. Like most people look at the Dow, but that's only like 30 stocks, right? That's only 30 companies. And that's why one of the reasons why I like what Peter mentioned was the S&P 500. He was talking about the S&P 500, and that's 500. That's 500 companies. And I personally, as a boring indexer, that's what I choose. I like the S&P 500 because it's more inclusive. It's got more. But I do also like an all market fund or an all world fund. And so when you're talking about the stock market, it's important to realize that even though, most of the time when we talk about, the world is ending, the Dow is down 500 points, we're talking about 30 stocks here, people. We're talking about 30 stocks. So there are more than 5,000 that are publicly traded in the U.S. alone. So I think a little perspective here on what we're talking about when we start like freaking out about the stock market, going down.
So, look, okay, I think we're coming to a consensus here that,
It's so boring.
You can't put too much into maybe what you see in the news and what you hear. But do you think there are times when a person should pay attention to what they're hearing in the news? Like the market is moving down, the market is doing this, the market is doing that. I don't think that people shouldn't pay any attention at all. Do you? Like, when should somebody go, all right, that's something I need to take note of. Maybe I need to adjust based on this.
Well, let me maybe rephrase the question a little bit, Glenn. My rule of thumb is if you need money within the next 5 years, it should not be in the stock market, period. And I know that some people will take a stance with that. If you understand how stocks and bonds and everything else works, great. You can pay attention and do what you want. But for the average mainstream individual, my rule of thumb I tell people is if you need that money, if you need it to send your kid to college, if you need it for a down payment on a house, if you need it for a wedding or whatever the case may be, that money should not be in the stock market. And if you follow that very conservative, granted, rule, then I think you can pretty safely ignore all the news. Now, if you don't want to follow that rule,
here's where I don't follow the rule.
well, you write, so you have to know.
No. So I actually keep my emergency fund in an all market fund, like my emergency fund, like that I might need money for next month. I keep that in an all market fund, and then I also recently started a travel fund for my son and I have that in. Well, that one's a more conservative mix of stock index funds and bond index funds. I mean, that one's got, the travel fund has a little bit of bond fund goodness in it. But one of the things I've found about having it in there is even if I have to sell at a loss to pay for, when my basement flooded, I still got a tax deduction for it because I tax loss harvested the loss. But here's the thing is, so even if it's down a little bit and I still have to pull it out and lock in those losses, overall, for the most part, I have enough in there now and it's built up enough and it's been enough of a return that even if I have to take the capital out, what I've got there is an amount of capital that is large enough that it can withstand, 1,000-point drop or whatever and move forward. So I don't know. So I guess
I'm interested in this because we so rarely disagree on this show.
I know, right?
So would you advise, because I see what you're doing in tax loss harvest. I mean, I have no doubt that you will be ahead of this game, Miranda, at the end of the day. Would you advise 80% of Americans and Canadians to follow that?
No, God, no.
God damn it. I thought we were going to have a good back and forth.
No.
So let's discuss what's wrong with that.
So no, I have 3 weeks worth of expenses saved up in a liquid savings account that I can get to tomorrow. So if something serious happens in my financial life and I have to get to it now, I've got 3 weeks that I can do this stuff with. But if I need something longer, then I have time to liquefy what's in my investment account. But yeah, no, most people don't have that buffer, and most people can't handle the stress that comes with it. And I've only had to use that emergency fund one time in the 5 years I've been 7 years. 7 years I've been doing this. I've only had to use the emergency fund one time in the 7 years I've been doing it. And I didn't even have to, and it only comprised a very small percentage of what was in there. And so, yeah, so that small amount of capital that I pulled out, at the time that I did it, the market was down and I had to take a loss on it. And so then I just did a tax deduction for it. But for most people who are living on the edge, and what are the most recent things? 65% of Americans are still living paycheck to paycheck and have no savings. If you're in that situation, then no, this is probably not the plan for you because it's not very liquid. You can't just go down to the bank and get it right now. And you're probably going to be stressed out about when the market is down. So anyway,
accountants in China start playing with figures.
That's right. So somebody else tell me why I'm wrong. Go.
Well, I want to point out that from what you just said, it sounds like you have different layers of emergency funds.
Yeah.
Right.
Yeah, because once I get to more than 3 weeks worth of expenses sitting in my emergency fund, I'm sad because of just the really poor yields that you get on any sort of savings account. The ones I've got more than 3 months worth of chunked in there, 3 weeks, 3 weeks worth chunked in there, I feel sad about my yield, and so then I just want it actually working for me in a different account.
And in your stock part of that emergency fund, I mean, you don't have to give us numbers, but how far of a cushion is that? I'm going to guess you have a pretty big cushion in there if you could take a big drop.
Yeah, I got 6 months worth of expenses in there. And when you think about So it's not like huge or anything. And that's the other thing is once I get more than that, I move it to a different account. Because I'll move it to like, if I have room in a retirement account, I'll move it to that. Or if I have room in my new travel fund, that's probably where I'm going to move it now, is move it to the travel account.
So, I mean, but the big thing about emergency funds is there's no one definite amount that you need to have in there, right?
Oh, right,
It
yeah.
really depends on each person and what their industry is, too. So if you have 6 months in there and they're in stocks, and for some reason the stock market, I mean, goes so... Let's put this in context. We're talking like a few percentage points. The
Right.
last week or so, you would lose.
Yeah.
You would have to lose half the market for you to go from like 6 months to 3,
Oh, yeah.
right?
Yeah.
So I mean, you're still in a pretty strong position there, and yours is
Right.
an industry where you're producing it yourself. You're pretty familiar with what you're doing. You've had a
Right.
lot of consistency. Nobody's really going to fire you from one job where that's going to hurt you. No,
Who
I'm
knows?
putting this.
No, you're right,
A
though.
lot of other people they're in.
That's a big difference with Miranda. Yeah, she's
Right.
got freelancing working for various people, but if
Right.
you have just a regular job,
Her job itself is diversified.
yeah, with a regular job, the time you're likely to get fired is probably the same time that the stocks are dropping. Whenever the economy
Right.
starts to go down, and you wouldn't want that perfect storm of losing your job and your emergency fund all in the
Right.
same time period.
Right.
So
And-
I mean,
And that's a good point that Tom makes. Like I said, like when you asked, like 80% of the people in US and Canada should probably not be doing what I do.
but it also shows that when you have all your everything else in place and it's working for you and you've built up a cushion, you can do more with things, and you can be a little more flexible too. So I mean, it's certainly kind of an idea that maybe if you want to shoot for it one day, but like you say, I don't know that that's practical for most of the people who will be watching and listening to the show.
It's true. But hey,
Well,
if you're a
Matt-
freelancer, you know.
And Miranda has a lot of options. She just explained she's given herself a lot of outs, doing different things. Where I see a lot of people sort of panic is the retired people entering retirement, and the retired folks that have to withdraw their portfolio and their savings and investments in order to live, to cover their day-to-day costs. And man, if you are approaching retirement and you are like 100% or 90% or 80% in stocks or stock-based mutual funds and ETFs, man, you had better know what you're doing and better be really confident, because you are really setting yourself up for some stress when no one has any idea what's going to happen in China. If they do, they're running a hedge fund somewhere and making money off it. The guys on TV, you will never convince me they know what China or Greece or whatever. The people in Greece don't even know what Greece is going to do. So how can you be basing your retirement on that? That's really risky to me.
Yeah, and there's one thing that I was thinking of. Retirement, you know how long you've got. Usually somebody can have an idea, age-wise when you're getting close. But one thing that popped into my mind in the last week is a 529 plan, like a college savings plan. For those that are north of the border there, they might not have the 529, they probably have other things. But
RESP.
right, your window is a lot smaller. That 5 windows now is like when your child is 12 or 13. Now you really do have to start thinking of it. So when you start hearing these numbers start playing around, you go, wait a minute, no, that could be the difference of a year's tuition and maybe a year's books. If you're not playing with things the right way. So I know that came to mind for me. Like I really need to look into my kids' 529 plans and look at what their ages are and look at how it's going to play out and how safe or not it is. And I think I'm really going to have to diversify some of that myself based on what I've heard in the week. Not necessarily because of the news. I'm not worried about what China's doing or anything like that. Just because it was like just a great reminder that I have to maybe play with the volatility of my oldest's account to make sure that it's not going to be too affected by that if I need tuition and the week before everything drops a few points. So I think that's maybe a good example of a case where, you might want to start maybe just investigating, not necessarily sell it all, but look into how you have it set up.
Yeah, I know we've had Rob Carrick on the show before, and he's written about that in Canada with the RESPs, how I think with his children, he was aggressive. I want to say, don't quote me, but 60 to 70% in a broad-based index equities when he started, and then as the children got older, and yeah, by the time they were 12 or 13, he had, it was either none or maybe like 20% invested in stocks, and the rest were cash equivalents. So you can see how, I agree, as your children get older, if you have a family plan, the average age of your children, you need to start taking some risk out of that, or live with the consequences, right? I mean, if you're making $250,000 a year and you can pay it anyway, you can pay your child's bills regardless of what happens, you can take the risk in that account. But I don't make that much money, so.
Yeah, really, I mean, that 529 or RESP is kind of like a normal person's working career in miniature. You could almost look at it that way. Instead of 40 or 50 years, you're looking at, 15 or 20 years. So you really just have to kind of take that whole career thing and miniaturize it and say, hey, I need to start shifting things one way or the other, and yeah.
Well, it goes back to what Kyle said earlier too, with the his 5-year rule. It would apply just for that too. Like Glenn said, at 12 or 13 or whatever, start to take the risk out because you need it in 5 years.
And I think when time always seems to just zip by you. The older you get, the quicker it goes. But with your kids, like, you forget, like 12, and all of a sudden now they're in high school, and you're going, oh, wait a minute, that account, like, what about that? And you all of a sudden you're starting to think about college and go, okay, yeah, how much do we have in it? Oh, wait a second, we had it all in high risk stock. Oh man.
I had it all on that Chinese railway, but
yeah, I mean,
that Chinese telegraph.
But the nice thing about a broad-based stock fund is that even if you tanks and you're going to have to say, well, I'll put off using it for a year or so or something like that. I don't know. The thing about the broad-based index fund as opposed to individual stocks is that you kind of spread that risk out a little bit more with diversity.
Yeah, well, I think about it this way. Like, I have no idea. You tell me any one or two specific stocks in the S&P 500, I have no idea. Apple looks good. So did Microsoft until Apple was, surpassed it. And I mean, Microsoft's still doing fine.
They might even be doing better these days. Who knows?
Yeah, but any one or two stocks, I have no idea. But I know that it's a pretty safe bet historically and looking forward. It seems to me logically that if you take the 500 biggest companies in the USA and you look at, maybe, I don't know where China's going, but I know that the best companies out of those 500 are going to have a pretty good idea. And they're going to have a pretty good idea of where to open a Starbucks, or, how hard is Amazon going to push their employees to make their stock go up, or whatever the news has been there. I have faith that those 500 biggest companies will keep on doing what they've been doing, and that's make a lot of money over time. They might take a hit here or there, but over time, as a group, they're going to make a lot of money.
Yeah, I mean.
Yeah.
Go ahead, Peter.
I was just going to say, investing in single stocks here and there can be kind of fun. You can almost get a little bit of a rush from it, just because, you find a certain stock and you watch it go up 50% in value or whatever. But the flip side is, the next day they could have a bad earnings report or something, and then it's going to drop drastically as well. And it's kind of like a roller coaster ride. It's a lot of fun until you go flying off the rails. So, on the other flip side of the coin, those index funds and diversifying across the market is kind of like a slow car ride up a long, long hill. It's not super exciting, but it's going to get the job done when it comes to it. So,
and it's not just us. I was just going to say, Glenn, it's not just us that don't really know where this stuff's going. I love looking back on what experts say. There's a guy up in Canada, Jeff Rubin. He's like one of our top economists. He was a big guy with CIBC Bank. Now he writes articles. He wrote this huge book called The End of Oil. Wrote it several years ago, and it was like, manufacturing's going to come back to North America. Oil's going up to $200 a barrel. It's going to save the planet. Everything is, and everyone was like, oh my God, this is the preeminent book of our age. And then, of course, it where's oil today? Wherever it is, it's going up or down between $40 and $50 a barrel. And doesn't look to be going up anytime soon. And we're finding more oil and how to get it out of the ground all the time, for better or for worse. And now Jeff Rubin's like, oh, actually, I saw this coming all the time. That's why I was writing how it would be bad for the environment. And I have that book. Someone bought it for me because they're like, oh, you're interested in this stuff. and this guy was literally the head of CIBC's entire trading department. So if he was so badly wrong on, and wrote a book on the one part of the market he was an expert on and was atrociously wrong, I think that shows like how dangerous it can be to try and predict commodities and things like that.
And I mean, maybe it's a scary thing. Maybe it's a good thing too. But technology has changed so much in the last 5, 10, 15, 20 years. You know, if the stock market's even going down, there's going to be so many new advances that come out that it's just going to be insane. You know, think about Apple's growth. Where did they come out of? Like, they made their computers look really nice with like the see-throughs tops, and you're like, oh, that's great. And then all of a sudden this iPod thing comes out, and then iTunes comes out. Nobody was able to expect what their next product was going to do. Now, their next product can completely tank, and somebody else can come out with something better, and all of a sudden it goes down. But what I'm saying is that there's always something bigger that's going to come out. You're talking about oil. Well, what if Elon Musk comes out with some kind of like sun whatever that, you know, revolutionizes everything, and now all of a sudden, you know, he's the next, you know, oil baron, but he's the oil baron of the sun. You know, we don't know.
I love that.
It's like the next Montgomery Burns, and he's blocking out the sun and making money off of it. But we don't know, but the opportunities for those things to happen are there. You know, there's always going to be some growth in technology that some company is going to be growing that we're going to be able to ride its back as part of a diversified portfolio.
Yeah, I was just going to say, and that company will be in the S&P 500.
or in the NASDAQ or in something at some point. You know, whatever company that you think you need to invest in, it's going to be represented for the most part in one of these funds. You know, unless you're really one of these high-end guys who can actually just buy in like an angel investor, which most of us aren't. You're really going to be able to find it somewhere else.
Speaking of not wanting to panic about stocks, that's why I don't individually buy technology stocks, because you're saying how what one company could come out of nowhere, but normally it's at the expense of another company that was doing something before, and keeping track of that would drive me insane. So I never touch technology stocks.
I mean,
it seems like the barrier to entry in tech is like nothing. Like, if you read any Warren Buffett stuff, like, what does Warren Buffett buy? He bought Heinz ketchup. You know why? Because if a new ketchup company comes in, how are they going to take on Heinz? Right? It's not going to work. They're not going to. Like, a comet could hit the Heinz plant and they'd still be the top selling ketchup. So, but if you're Apple, who comes up with the next thing, right? Microsoft was going to be the king forever. Yeah, I agree. Tech. There's some people that make a ton of money in that field, but man, you better know what you're doing. Better be smarter than I am, because I don't want to try and predict and read the news.
Well, look at the biggest sort of online companies and stuff 10, 15 years ago. They basically don't exist now. So I just couldn't imagine investing in these kind of companies.
What, AOL is like totally legit.
Yeah. And they don't even, their valuations are not even based on metrics. Like, I love shocking people when I'm like, yeah, Amazon's actually never made any money. And they're like, what? How is that possible? I just ordered like $500 last week. How have they not made any money? I'm like, no, Amazon has never made profit.
Well, I mean,
they don't make profits. But they're totally based on like their expansion right now.
At least Amazon has a product. Like, they sell
True.
something. They rent space. They do something. How about these social networks that
Uber,
are like worth billions, and you're like, how? Like, they really don't, earn anything because they don't really do anything.
It seems so hard to imagine something like Facebook being gone, but who's on MySpace nowadays? Like,
that's right.
Well, here's the thing: is it's like they're like, Twitter's right. Twitter's valuation is like billions, but they're like, but how do we monetize it? How do we make it profitable? It's like, but it's worth billions, but how do we make it profitable? Right?
See, and that's really the thing. There's always going to be the next big thing that people are going to get excited about, want to buy into. I'm reading this book about Cornelius Vanderbilt right now. Back then, the big thing that people were getting into was steamships. Oh my gosh, this is the next big thing. It's going to be here for 200 years, and you got to buy into steamships. Well, shortly thereafter, the railroads started getting real big. So everybody's trying to buy into railroads, and all these steamship stocks are going down the tubes. So you always have to think about these things in the long term. There's always going to be something new and something better. So why try to pick? Because you probably are going to get it wrong half the time.
Well,
And
that's
most
right.
of us aren't Cornelius Vanderbilt either. Where, where we don't have either the money or the knowledge to get into these things, to really know about it. Where usually if we think something is big, it's probably already too late. It's
Oh
probably
my
already
gosh,
peaked.
yeah.
Like, I don't know who it was, but what was it like? He was getting his shoes shined, and the kid was trying to tell him like what stocks to buy, and then he knew like, okay, this is done. We're about to.
We're all done with this
fall.
now.
Yeah.
It's like that story that this guy JD was telling us at JD Stein, who does Money for the Rest of Us, was telling us at dinner in Dallas a couple weeks ago. Well, about a month ago now. And he was talking to us about it, and he's like, yeah, when my exterminator was talking about some of this stuff, it's like, oh, I know that it's the end.
David Chilton, who wrote The Wealthy Barber, he has a great one. He goes, when teachers talk to me about borrowing money to get into the stock market, I know that that's it. I cash everything out because I know that that's like my weather vane. When teachers are borrowing money, get out because you know that something's about to happen.
I'll have to keep my
We've reached the top.
my finger up for that one. That's interesting.
So basically, we just need to watch Glenn and Kyle, and when they start borrowing money to leverage their positions in the stock market, that's when the rest of us need to be done.
Well, I'd like to think we're the exception, but
You're not gonna leverage your whole life to like get into the stock market.
no. But if you got $20, I'll. Like if I really want an individual company, I'll supplement it as a small portion of like everything else that's diversified.
Okay. Kind of like a fun, like your
Fun money.
your play money, your play portfolio.
Yeah. And I like to think I do well in that, but I'm not putting enough in there because I know even if I happen to be doing okay, it's not. I don't know. Nobody knows what's gonna happen.
Well,
Do
so
you
here-
think people should genuinely be afraid though?
Well,
Yeah.
I think you should be worried if you don't have a plan and if you don't know the purpose of your money and what it's doing there. If you're just randomly going, well, 401k, and you don't know why you're doing something with your money, and you don't at least have an idea of like, what is your goal? What are you trying to hit? What is your money trying to do? What do you want your money to accomplish? If you don't understand that, and then it just doesn't matter, and then that's when you should be worried.
I think also like talking while we were just discussing how like when every person's talking about one thing, maybe that does add a little bit of caution when everybody's so positive about this one thing.
Yeah.
That maybe like you gotta go, all right, maybe it's time to pull back a little bit. What you think about real estate in like 2006 or so, it was like the thing. It was on TV. It was everywhere. All you had to do was buy a property and flip it, and you were going to be rich. Because property values were going to, like, when so many people are doing it, you gotta kind of go, if I'm invested in that, maybe now's a good time to pull back a little bit. When there's like 4 TV shows talking about it, and
Well, that's the thing, though. It's like what you were saying before. Is by the time it's common knowledge, you're already reaching the top. And that's once again the beauty of indexing is because instead of having to worry about like one thing and whether that one thing is really going to still be the big thing or is really going to be helpful to you, if you're doing a broad market index, then you're just doing the whole market over a long period of time. And over a long period of time, over 25 years, if you look at it, none of the indexes have ever lost, have been negative over a period of like 25 years. And so if you have a long-term view and, you're okay with the broad market, do that because eventually you're still going to be better off. I mean, think about even if the market drops to 9,000 tomorrow. If you got in while the Dow was at 6,000, even if it drops from where it's at today, you're still ahead. Right? If you got in 2009 when the Dow was down to 6,000, and if tomorrow it suddenly drops to 10,000, you're still ahead. And a lot of people just look at it and say, oh, this is what I had today, and now here's what I have, this is what I had yesterday, and now here's what I have today. Well, compare that to what you had, 5 years ago, and you're still ahead.
And in 20 years, the financial podcast will be talking about Black Thursday. Remember that Black Thursday of 2015?
That's right.
That Miranda cursed us all. But it is all relative, right? And like, okay, China, they lowered their projections. They didn't say that they were going to close their doors and not buy anything ever again.
Oh, I know. Like
Right.
China slowing down is, oh my gosh, we're doing 6% a year. Good Lord, we're slowing down. That's China slowing down, and what would we be happy? We'd be thrilled to death to be seeing 6% year over year. It's ridiculous.
Yep. It all comes down to having that long-term view. You look at any 1 or 2 year period. Oh my gosh, the world is coming crashing down. You have the line going down to the right. Then you pull back just a little bit and you see, oh, okay, it's starting to go back up. And over the long term, it's just basically going up to the top right. So yeah, just take a deep breath, take a step back, and try to get a bigger view of what you're looking at.
And panic affects stock investors so drastically that I've done a lot of reading, and whatever it takes, however conservative your portfolio needs to be to allow you to sleep at night, and that's different for everyone depending on everyone's situation, do that. Because nothing's going to hurt you worse than panicking and selling and buying and just doing all these terrible things that we've talked about on this show before that really, really cripple your long-term returns. So whatever you got to do to convince yourself that you can ride out anything, do that.
Yeah, if anything, this last week or so really is a great litmus test for your own risk tolerability. Like if you really were worried in this last week, doesn't mean you should sell everything, but what will make you comfortable? If you need to maybe pull back a little bit on stocks and push a little bit more here for now, you don't want to tell people to just get so safe that they're not going to take advantage of that growth that stocks give. But if you think you're doing something that might be a little too risky, okay, now might be a time to change your diversification or your allocations.
Yeah, I think a lot of people.
Not because of the Chinese thing or anything else, but because long term that's what you need to do to be able to sleep at night.
Yeah, I think you hit on a good point there, Glenn. Like a lot of people have written about the millennial generation, and we are scared to death of stocks. We don't understand them. It was I don't think any generation, the mainstreams really understood stocks, but at least the general feeling was that they were a good thing, owning businesses was good for you. But now millennials have this weird super fear because of all these newspaper headlines and these 24/7 news channels and all these crazy things.
Well, and don't
just
forget
blowing everything up.
Don't forget they watch their parents freak out over their retirement funds.
That's right.
And also maybe the rate of change of technology has been changing probably more now than maybe ever before. Also, you can't hold on to any one thing and expect it to always be the case. I don't know that the iPod 19 will ever exist.
But Heinz ketchup will. Yeah.
There you go. So, what do you think might really crash things permanently? I'm thinking zombie apocalypse. Then I think real productivity might stop and you might not get that growth again.
I think if we
invest in guns. Yes.
But even production's going to stop.
You're right.
Right. Yeah,
no, I meant hard market, black market, buy guns.
Buy guns instead of right. All these people who are buying gold. What are you going to do with gold? Going to throw it at people?
That's what I always think, Glenn. I never understood that philosophy. Buy gold, the world's going to hell. Oh, just take my brick of gold and go get some fresh water.
It's no, give me beans maybe.
Yeah. So, I'm back. I'm back in the mountains. Back to the just outside the wilderness. So, my big investment is I got my fishing pole fixed, and I got my tackle, and I got my gun. I can go get any food I want. and the river is just right there.
You sound ready to run for president there, Miranda, with a stump speech like that. But
Yeah, right. No, I really think the only thing that would really, really crash the system is like in sneakers, right? Oh gosh, I've dated myself. So please, Glenn's seen Sneakers anyway,
Oh,
right?
yeah.
I don't know what movies.
I have that on VHS.
Okay, yes, thank you, Tom, thank
Is that
you.
a silent film or something? Or-
No, but no, it's like
Was that talking?
yeah.
Was that in color?
It's like so it's classic. It's Robert Redford. It's funny as hell. Go get it. Anyway, so anyway, the point is even as old as this movie was, they understood information. And what the guy says is it's all about the information. The world is run by ones and zeros. And the only thing that I can really see like are really crashing is if something really crashes our technology and wipes out the information. Because really, honestly, most of our wealth, most of everything we have is basically digital. I mean, think about it. How much cash do you have right now in your wallet? It'll be worthless in this scenario anyway because of inflation. But how much cash do you have in your wallet right now? Our entire economy is based on the way information moves and the way that your company says, oh, by the way, we've direct deposited this money into your account. They didn't deposit real money in your account. They sent some information to your bank.
Wait. I'm
Yeah,
not
but-
sure that you're instilling like confidence in people right now. Like
Oh,
one big
it's
giant electromagnetic
So-
pulse can knock out.
once again, though, I'm not overly concerned because I'm a student of history, and as long as the rich, powerful people have their money where I have my money, I'll be okay.
Oh, so you think that they do?
It's all in gold or
Well,
guns.
cans of chili.
Golden
Or
gun.
Heinz ketchup.
Cans of chili.
You know, it's
Heinz ketchup is good now or good if the world goes to hell. Everyone will still want it.
I prefer Trader Joe's actually, but
Oh
There you
yeah,
go.
the Trader Joe's ketchup. That's great. I can't get it anymore.
a lot of these people who are like billionaires, their money's paper money anyway, or like virtual money. Like Mark Zuckerberg, I mean, he's got a lot of money, but a lot of it's in the stock of his company.
Oh boy, we're going off the rails here.
You're so off the rails.
Well, are we not talking about? I don't know.
No,
What was
no,
the
we
topic
are.
of the
We
show
are.
again? We're on to the
Don't-
zombie apocalypse and
don't freak
golden
out.
guns.
You're either going to be just fine if you stay the course, or everything's going to go to hell anyway, and it won't matter. There you go.
The end.
Moral of the story,
Who's
basically.
feeling good?
Well, I'll let you guys develop the moral of the story. Let's go around and wrap this up. What are your final thoughts on market volatility? Like, what do you do? Tom, tell us your thoughts.
Well, I think it's basically what we said was diversify and just kind of ignore all the noise. Like we don't, I haven't looked at my stocks in the last couple of weeks. Partially, like you said, Glenn, just too busy. But also, I didn't need to know. I was good not knowing. So just keep calm and carry on.
Worked in World War II.
Thanks for the sponsor of the show.
Peter, what are your final thoughts?
Just more of the same. Just set yourself up so you don't have to worry about these short-term crashes or bubbles or whatever. You know, they've been happening since the markets began. You know, the great crashes in the 1800s, the 1929 crash to 2007, 2008 when we had the big crash. So, you know, those things are going to happen. But just set yourself up, diversify with index funds, know your tolerance for risk and adjust your investments according to that, and know your time horizons and how long you have to invest and again, adjust accordingly.
Miranda, what are your final thoughts?
My main complaint is that, you know, the S&P hasn't fallen far enough for me to feel like it's worth it to buy extra shares. So, you know, I could handle it falling a little bit more because
So you are
Bargain
hoping
hunting.
for a big drop tomorrow.
sure. Well, no,
I am.
the bottom line is I'm not taking anything out, but if it gets low enough, I might put something in because when I'm looking at the long term, once again, like Peter was saying, like Tom was saying, look at the long term and stay the course. And if you're going to do something, if you're going to go out there and do something, for heaven's sake, get a bargain. We buy everything else on sale, right? Might as well do this too.
I'm just thinking Dana Carvey doing George Bush. Stay the course. 1,000 points of light. But anyway.
Well, we're always talking about buying stuff on sale. Go buy on sale. Go comparison shop. Well, now is your time for a bargain.
Kyle, what are your final thoughts?
Yeah, despite my stress-induced extreme aging, I am only 27, so I'm definitely cheering. I hope stocks tank. I'd love if 2009 happened again and the newspaper headlines went berserk. I'd be like sharing them on Facebook, trying to get people to go even more wild, just so I could continue to buy more stocks. The bottom line is that one stock, one sector, one market can go down for a long period of time. But I have faith that the 60 biggest companies in Canada or the 500 biggest companies in the USA, over time, they're going to keep making money because that's what good companies do.
There you go. Look, don't let any short-term news make you go crazy and do something you're going to regret. So, long-term look. And until next week, it's been a lot of fun. Be good with your money. Good night.
Thanks for joining us on the Money Mastermind Show. Get more information at moneymastermindshow.com. Don't forget to subscribe to the show on iTunes and YouTube and follow us on Google+.